In the subject of fundamental of investment, in today's lecture, I'll be talking of valuation of equity shares. In my previous lecture on valuation of equity shares, I told you that the valuation of equity share is different than that of the fixed income securities, and especially in terms of the bonds. Since in equity shares or in equity, the income keeps on varying, unlike the bonds, where the rate of interest is fixed and the interest that is being given on the bonds remains fixed, the maturity period is fixed, and what you will get after the maturity, that is also fixed, that is also predetermined. But here in equity shares, the income that will be generated by the equity investment in form of dividend is not fixed. It varies depending on the growth of the company, depending on the various factors, depending on the dividend policy of the company. There are various factors which affects the dividend income on the equity share. Similarly, there is no fixed tenure, there is no fixed life. Equity shares are once being issued, they are issued for infinite period of time. So we follow that company is a going concern, and since company is a going concern, so the price at which you will be selling in the market depends on what stock market, what price the stock market gives to a particular equity shares. So means the selling price is not fixed. It is not in your hand. It is not predetermined. It depends on the performance of the company. So what will be the selling price, that is also not fixed. The income that is being generated by the equity share in form of dividend, that is also not fixed. So because of these reasons, the valuation of equity shares is more difficult, in the sense it is more complicated as compared to the bonds. And how we value the equity share, there are different models, there are different ways in which the valuation of equity share can be made. And one of the model which I discussed in the last class is the last lecture, the zero growth or constant dividend model, in which we presume that dividend will remain same, constant over a period of time. So it is very simple to calculate. When you have a constant dividend, we say price P0 is the current price of the share, it should be equivalent to the D is the dividend, right? KE is the required rate of return on the investment, right? So dividend divided by the required rate of return, which we call it KE, gives you the fair value of the share. Similarly, in my previous lecture, I also talked about constant growth model. What it means, constant growth model means we presume that dividend will not remain constant. It is also practical that dividend in the life of the company will not remain constant. It will keep on growing. But to keep the thing simple, we presume that dividend will grow, but it will grow at a constant rate, right? So if today the company is giving, means in the current year company is giving 2 rupees dividend, and if the growth rate is 10%, I'll say in the next year the dividend will be 2 rupees plus 10% of on it, that is comes to be 20 paisa. So next year dividend will be 2 rupees 20 paisa. In the next year the dividend will be, means after the second year the dividend will be 2 rupees 20 paisa plus 10% on it. So this is called constant growth. The rate at which the dividend is growing is constant. So we say D0 means, what is D1? D1 means dividend in the first year. D0 is the dividend in the current year. So D1 is equal to D0 into 1 plus G. Similarly, if I talk of D2, that is D1 into 1 plus G, and so on and so forth, right? So if we calculate this, we use this method. So we say DT, dividend in the T period, will be D0 into 1 plus G raised to the power T. T is nothing but the time period, right? So simply, if we use the constant growth model, the valuation of the share will be, that is dividend in the first year, which we call it D1. P0 is the current price of the share, means what should be the current price of the share given the dividend, given the growth. KE is the required rate of return on your equity investment minus G. G is the growth rate. So by using this model, by using this formula, you can find out the valuation of the share if the growth rate is constant. That is, I am repeating, the P0 is the price in the current year, is equal to price in the current means zero period is equal to dividend in the first year D1 divided by required rate of return, that is KE minus growth rate, right? So by using this formula you can find out the intrinsic value of the share or the current real current value of the share. Market may give different price than the price which the share should fetch. On the base of this, you will decide whether to buy the share or not to buy the share. Means that if P0 comes to be, say for example, by using constant growth model, if the P0 comes to be 50 rupees and in the market the price of the share is 40 rupees, it means share is undervalued and you can buy the share, because the real worth of the share should be 50 rupees as per the constant growth model is, in which we are presuming that the dividend will grow at a constant rate. So means when you calculate P0, by calculating the P0, you come to know that what should be the valuation of the share on the basis of dividend model, on the basis of dividend in the dividend model, constant growth model, where we are presuming that the dividend will grow at a constant rate. So if it is undervalued, you should buy the share. If it is overvalued, means P0 comes to be 50 rupees and in the market because of some reason it is fetching 55 rupees, right? The market price of the share is 55 rupees. It means as per this model, the share is overvalued and you should not buy this share, right? So how the growth rate is determined? This also I discussed in my previous lecture, that the growth is determined on the basis of past trend analysis. What has been means how you will come to know what is the real growth of the company, what will be the real growth of the company. If it is an existing company, you find out that what has been the average growth rate over a period of time. Supposing for the last 20 years, what has been the average growth rate of the dividend of the company, right? And when the company is making profits, what proportion of profit the company is keeping with itself, that is called retention ratio. Retention ratio means like if a company earns 10 rupees per share, right, and if it gives 40% in form of dividend, it means 60% is your retention ratio, which we call it B for retention ratio. That is 10 rupees minus 4 rupees, that comes to be 6 rupees. Or if I say, if the retention ratio is 60%, it means that company pays 40% of its earning in form of dividend. And return on equity means how much return the company earns on its investment. So as per Gordon model, growth rate can be determined by G is equal to B. B is nothing but your retention ratio multiplied by R. R means return on equity. R is denoted by, or R symbolizes the return on equity, right? So we have taken a very simple example. Suppose an XYZ Limited is currently paying dividend of rupees 2, which is expected to grow at 5% per annum forever, right? Means we are following constant growth model and we are presuming that each year the rate of dividend or growth of dividend will be 5%. Find out the value of the equity share if capitalization rate is 10%, right? Capitalization rate is nothing but the required rate of return of the investment. So D0 is equal to 2, G is equal to 5%, right? So D1 comes to be D0 into 1 plus G, right? This comes to be 2 rupees 10 paisa. So 2 rupees and 5% of it comes to be 10 paisa. So D1 becomes 2 rupees 10 paisa. That is 2 multiplied by 1 plus 0.05, that comes to be 2 rupees 10 paisa. So current price of the share should be 2 rupees 10 paisa divided by 10% minus growth rate. 10% is KE, required rate of return, or we call it here capitalized rate, and 5% is your growth rate. So if these are the facts, then the share should fetch 42 rupees. The real price of the share, the intrinsic value of the share is rupees 42, right? So we use the formula V0 is equal to D1 divided by KE minus G. K is nothing but the required rate of return. Means when an investor is investing in an equity share, what is the minimum return which the investor expects? That is called KE. K is the required rate or capitalization rate. At what rate you will capitalize the income, right? So that is KE. Now, A more practical thing is variable growth model. What this variable growth model means, normally it has been observed that the rate of growth of dividend does not remain same throughout the life of the company. It keeps on varying. Means say for example, to keep the thing simple, I am presuming that for the first 3 years there will be X rate of growth, say 5%. After 3 years, the rate of growth will be more than 5%, say 8%, 10%, right? So what we are saying is that growth will vary, will keep on changing. For some number of years, there will be particular rate of growth, and then in the later part of the life of the company, as the company will grow, company will expand, the rate of growth will also increase, which is known as variable or multiple growth model. Unlike the constant growth model, in my previous example, where I said that the company will grow, when I am saying company means I mean to say dividend. Dividend of the company will grow at a particular rate, right? Supposing I am presuming the company will grow at a 5%, the dividend will grow at a 5%. But here in the multiple growth model, we presume that the rate of growth of dividend will also change, which is known as multiple growth model. So this model is more realistic because the dividend may change year over year, that is one growth rate remains same for one or few years, followed by other growth of rate for the next years. That is, as I said earlier also, say for example, first 3 years of the company will grow at a, say 5%. After 3 years, the rate of dividend will grow at say 10%. It can be anything different from 5%, right? So in that case, how you will calculate, how will you find out the real intrinsic value, or how will you find out the current value of the share? Then we can say the P0 is equal to the current value of the share is equal to D1 divided by 1 plus KE raised to the power 1. Raised to the power means after the first year, what will be the dividend after the 1 year? After second year, that is D2 divided by 1 plus KE raised to the power 2. In the third year, dividend will be D3 divided by 1 plus KE raised to the power 3 plus D in the means in the next after 3 years, D infinite period means after 3 years I am presuming, to keep the thing simple, after 3 years it will grow at a particular rate. The rate will change. It will not be the same as was in the first 3 years. So D infinite divided by 1 plus KE infinite, right, raised to the power this. So say let me explain this with an example. Suppose X Limited has paid a dividend of ₹3 per share. That is, in the current year, the zero period, the company has paid ₹3 per share as a dividend. And dividend is expected to grow at the rate of 10% for the first 3 years and 15% thereafter forever. So what I am presuming here is, in this example, that in the first 3 years of the company rate of dividend will grow at the rate of 10%, and after that it will grow at the rate of 15%. It is not necessary that I should take that 15% forever. I could have taken that 15% for another 5 years and then after 18% forever, right? So depending on, I am keeping the thing simple so that it is simple to understand, right? So I am presuming in the first 3 years at 10%, and after that it will grow at the rate of 15% forever. So, and I am presuming here in my example that the required rate of return on investment for an investor is 20%. So find out the true value of the share. So there are three things rather. One is that you are given current dividend, that is ₹3, which will grow at the rate of 10% for 3 years. Then after 3 years, the company will grow, means the dividend will grow at the rate of 15% forever. And the required rate of return of the investor is 20%. If this is the case, then what will be the true value of the share? This is a problem before us, and how we'll find out the value of the share. So as I said earlier, that D0 first we'll find out what is D1, D2, D3. D0 is 3, So it means D1 will be 3 multiplied by 1 plus rate of growth, that is 10%. So 1.10, that comes to be 3 rupees 30 paisa. What will be the dividend in the second year after the two year, right? 3 rupees 30 paisa, right? Multiplied by 1.10, that is 1 plus growth rate, that is called 3 rupees 30 paisa into 1.10, that comes to be 3 rupees 63 paisa. What will be the dividend at the end of the third year, right? That will be D2, that is 3 rupees 63 paisa into 1.10, that is 1 plus D2. What is D3? D3 is D2 into 1 plus rate of growth. Rate of growth is 10%, right? So that comes to be 3 rupees 99 paisa. So what will be the price at the end of the fourth year? Supposing I want to know, right? So P4 will be D4 divided by cost of equity minus growth rate. That is 4 rupees 59 paisa. What will be D4, right? Because after 3 years, it will grow at the rate of 15%, right? So 4.59 divided by KE is the required rate of return is 20%. My growth rate is 15%. So 4.59 divided by 0.20 minus 0.15, right? So that comes to be 91 rupees 80 paisa. So market price at the end of the fourth year will be P4 will be 91 rupees 80 paisa, right? I mean, you can calculate with the help of this present value of share, and is up till this, that is D4, market price at P4 you have calculated. Supposing we use the calculation of the present value of the share, right? So P0 is equal to present value of 3 years dividend, that is D1, D2, D3 plus present value of P4, right? P4 means what will be the price at the end of the fourth year, right? So if we use, I mean, earlier we have calculated what will be the price at the end of the fourth year, and if you want to calculate the present value of the P4 and the share, so then you can take it like this. You will calculate the present value of the dividend of 3 years plus present value of the price of the share at the end of the fourth year. That will be give you the price of the in the current year, true value of the present share, true value of the share in the zero period. That will be P0. Friends, let us make it very clear that earlier what we have done is we have calculated what will be the price at the end of the fourth year, right? So price at the end of the fourth year is being calculated by, that is D4 dividend in the fourth year divided by cost of equity minus growth. So that gives you this 91 rupees 80 paisa is the price at the end of the fourth year. What I am interested in, what is the problem before us? What should be the current price? 0 means P0. P0 means at present what should be the price? What should be the true value of the share? In that case, I have to calculate the present value, P0, right? And for calculating P0, right, what is a simple way? Simple way is you calculate the present value of the stream of dividend income which you will earn in the first 3 years. That is D1, D2, D3 plus the present value of the price at the end of the fourth year. That will become your P0. So how you have calculated? As we have already seen, the first year dividend is 3 rupees 30 paisa, right, into 0.833. What I am doing is I am calculating the present value of the dividend where this 8.833 has come. That is, if we use the discounting table, means by using discounting model, that is, what is this 0.833? If our required rate of return is 20%, what we will do is that we will calculate the present value of the dividend in the first year by discounting this value by at the rate of 20%. So if I get 1 rupee at the end of the first year, and if my required rate of return is 20%, what is the present value of this 1 rupee? This present value rupee comes to be 8.833, right? That is, you can say 83 paisa, 83.33 paisa. So what I am getting is dividend 3 rupees 30 paisa. So 3 rupees 30 paisa multiplied by 0.833. Similarly, what is the present value of the dividend in the next year? D2. Again, 3 rupees 63 paisa is the dividend in the next second year, at the end of the second year, multiplied by present value factor. Present value factor, that is, if you get 1 rupee after 2 years, what is the present value of 1 rupee if the discounting rate is 20%? That comes to be 0.694, right? So what dividend I'll be getting? 3 rupees 63 paisa. So this 3 rupees 63 paisa will be multiplied by 0.694. Similarly, what is the present value of the dividend in the third year? Dividend in the third year is 3.99. So 3.99 multiplied by present value factor of 1 rupee at 20% discount rate, which is our required rate of return. That comes to be 0.579. So 3.99 multiplied by 0.579. If you add up all this, you will get the present value of 3 years dividend which you are going to get after the first year, after the second year, and after the third year. Plus, you will also calculate the present value of the share which you will be getting after fourth year. We have already calculated P4, that comes to be 91 rupees 80 paisa. So 91 rupees 80 paisa will be discounted by present value of 1 rupee at 20% discount rate. Means if I get 1 rupee after fourth year, what is the present value of 1 rupee if the rate of discount is 20, which is our discount rate, which is our required rate of return, 20%, it comes to be 0.482, right? So friends, the current value of the P4, if the required rate of return is 20%, is 44 rupees 33.3476. That is the present value of stream of dividend which you are going to get in 3 years. That comes to be 7.5783 plus the present value of the price at the end of the fourth year. That comes to be 44 rupees 3.3476. And the total of it comes to be 51 rupees 92 paisa. So in this way, friends, you can calculate in the multiple growth model the present value of the share, right? So there are 2 steps involved. One is you calculate the price any number of years, that is if I want to sell the share after 10 years, right? So after 10 years, what will be the P10, right? And then you will calculate the dividend income which you will be getting in the first year up to 9 years, right? And you discount this dividend income with the required rate of return, that will give you the present value of the stream of dividend income which you are going to get by making an investment in that share. Plus, you will also calculate the present value of the share which a shareholder will get if he sells the share after 10 years, because I am presuming, supposing my holding period is 10 years. So what will be the price at the end of the 10 year? This I have calculated. I have shown you how you calculate, suppose at the fourth year, that is D4 divided by KE minus G. I am presuming in my example that if I sell the share after 10 years, so what will be D10? D10 means the dividend and divide by your cost of equity minus growth, right? So this way you can calculate what will be P10. So and if you calculate the present value of stream of dividend which you will be getting in 10 years, right, and the current value, the present value of the share price of after which you will be getting after 10 years, you will come to know what will be the current price of the share. So this is called variable growth model, friends, right? So up till now what we have done is that we have calculated the valuation of shares by following dividend discount model. In the discount model, in my previous lectures, I had presumed that the holding period is constant, that is for 5 years, 10 years, 2 years, 1 year, whatever it may be. So what will be the value of share? I am presuming that holding period is not given, is not fixed, right? And the dividend discount model is being followed, there are three different situations in the dividend discount model. One, where the dividend will remain constant throughout the life of the asset, how you will value the share. Second, if the dividend will grow at a constant rate, how you will value the share, right? And in third is variable growth model, which means that the rate of growth of dividend is not constant. For some years, the rate of growth will be a particular rate of growth, and then after that, in the following years, after those years, the rate of growth will change. So, which is known as variable growth model, the example which we just took before this, right? So, these are called very different growth model, and on the basis of which different growth model, how you value the equity share. Thank you very much.